Okay, well, good morning, everybody on the West Coast, and welcome to a webinar titled Valuing a Propane Delivery Business, a Fictional Valuation Experience. I'm Josh Wolf from Cetane Associates. I'm live from our satellite office in Bethesda, Maryland. I almost said Houston. I appreciate everybody taking the time to call in or check us out on online. So I'd like to give you a quick overview or a plug for Cetane Associates. Basically, we perform merger and acquisition advisory services. We do valuation work and transition planning for owners of heating oil, propane companies, HVAC companies, and we are very active. We've arranged 14 transactions in the past 24 months, and the size range is anywhere down from $1 million up to $53 million. So we kind of cover the gamut of down market transactions. These are some tombstones of some recent transactions we've done. You may or may not recognize some of the names on the slide, but we're pretty proud of them. Here's a quick overview of our team. Steve Abadi, who is the owner of Cetane Associates, is your upper left, and I'm right next to him. I'd like to point out Joe Rosengrant, who's on the other side of me, Joe recently joined us from the business development group at Thompson Gas, and Joe is going to be spearheading our relationships in the propane industry. So we do welcome Joe. Okay, buy more propane. So that's going to be the name of our fictional company that we're going to value this morning. I ripped this one off of the internet, but I thought it was kind of cute. It was a dark and stormy night, so this is how we're going to start out our presentation. So once upon a time, Buy More Propane, which is owned by Tommy Tutone and his wife Jenny. They own Buy More Propane, located in Buy More, California. If you are at all remember the 1980s, then you should probably figure out who Tommy Tutone and Jenny are. I'll give you a hint, there was a rock song associated with it. Buy More was established back in 1967 by Tommy's father, and he began working at the family business after college. It's a very common story. Back in 1981, and he basically navigated his way around the company. He did pretty much everything, and eventually he took over from his dad and assumed ownership with Jenny back in 2002. Buy More delivers propane in a market that has some agriculture, it's got some suburbia, it's kind of a mixed bag. Lower middle income customer demographics, if we want to look at the customer deck itself, it's pretty heavy residential at 67% of the gallons, 15% agricultural, and then 12% for commercial. Pretty good autofill percentage at 72%, and tank ownership control, that's really good at 82%. They operate out of a single facility that's got an office and a garage warehouse and a pair of 30,000 ASMEs and plenty of space for yard tanks and moving stuff around. So Buy More Propane employs 3 full-time drivers. They've got a full-time propane service tech, an office manager, and 2 full-time CSRs. Tommy also, he is kind of manages the whole company. Jenny's not as involved as she used to be. Vehicles that they operate, they've got themselves 4 bobtails and a couple of pickups and a tank set truck. The bobtails are late models, so are the service pickups. Tank truck is probably about 14, 15 years old. Competition, they have faced a couple of the 2 large multi-state operators. They've got 3 other independents that sort of overlap over their marketing territory, and there's very limited potential for natural gas because of geographical considerations. It'd be too expensive for the local distribution company to run lines into the area. So, all right, so how I want to do today's webinar is I want to set up a scenario, and the audience, you're going to put yourselves in the mindset of the person doing the valuation. And you may have questions that arise throughout this presentation. You're welcome to enter them into the questions function of the GoToWebinar. There's a little console there, and there is a tab that says questions. You can enter them, and I'll try to address the questions as we approach the end, since sometimes they deserve attention that they might not get if I do it in the middle of the presentation. All right, so let's see what's going on here. So Tommy was approached by somebody in town that wants to buy a 25% control, a non-controlling interest in his business. Non-controlling meaning a passive interest. It's an investment. Tommy's not ready to sell the whole company, but he's about 5 years away from retirement. It could be at the right price, attractive to take some of his chips off the table. We don't see this very often, but I think the mechanics of this scenario make it very interesting to understand from a valuation analyst standpoint. I guess so. Tommy's unsure if it's even a fair deal, and so he does what most folks will do. He calls up his CPA and says, "Hey, I got this offer. What should I do?" And he encourages him to reach out to your firm, the Really Smart Guys Valuation Service. All you guys do is value companies all day long. And you and Tommy have an introductory call. You call him up, and he tells you about his business, and he expresses his reason for getting a valuation. You want to basically understand the circumstances and the premises behind why he's showed up at your doorstep. So here are the questions that should be running through your mind during this conversation. So what's the purpose of this valuation? Valuations have lots of purposes. These on this slide are the general purposes, the most common ones that we see. And you'll see that Tommy's isn't really on here. It is kind of a sale, but it's a partial sale. But different reporting requirements for different engagements. So we need to know what the purpose of this valuation is. We need to know what's being valued. Are we just being somebody wants to know what the value of the assets of the business are? Like a bank might be interested in the assets that they're lending against. Or is it 100% of the equity? Does somebody want to know what he's going to possibly sell his business and wants to know what the value of his equity is going to be? And remember, equity is not necessarily walkaway money because of taxes when you sell your business. And then you also have scenarios where it might be less than 100% of the equity. Maybe you're gifting shares to your children over time, and these might be in 1% and 2% increments. So we kind of need to know how to value that. So another question then, you got answers to the first two, because we know we're going to just do 25% of the equity. What standard of value do you use? And so the question is, what do I mean by a standard? A standard tells us what the hypothetical conditions are that you're going to value this business, right? Because it's not a real sale, you have to have a framework. And there are different types of standards of value out there. The most common one, and the one we're going to talk about today, and the one people are familiar with, is fair market value. And that assumes the business is going to continue going as an operating business, and it's going to be widely marketed to a bunch of potential buyers. There are other standards, synergistic value. So that's value to a specific strategic buyer. To different buyers could have different values. It's that collection of potential parties that kind of creates that fair market value. But individually, it might be synergistic value. And intrinsic value is something that an analyst on Wall Street might derive when he's looking at mispriced common stocks. Fair value That's actually determined, by state law, and it differs from state to state. There's not one common definition for fair value, but how it differs, and I haven't defined fair market value yet, but how it differs is it doesn't take into account some of the discounts that we apply to a fair market value. And then liquidation value is when the company is just going to be sold as a non-operating entity. All the assets are going to be sold off piecemeal, and whatever's left over, that's what you get. So there's no customer list value, no intangibles. And so, as I mentioned, the type of value that's most common is fair market value. So let's talk about the concept of fair market value. And I'm gonna throw a few more technical concepts in there before we then move forward, armed with those concepts to tackle the evaluation. So this is really as cut and dry of a definition you can get for fair market value. Business is a going concern. Nobody is forced to sell. It's not, a seller doesn't have health reasons that he needs to sell in the next 2 months. I mean, he has to do a forced sale, or he's not undergoing divorce proceedings. So it's basically neither party is compelled to do the transaction. And the transaction's out there for a reasonable amount of time so that everybody could become aware of it. It involves just cash, not any other form of structure. And basically, we assume that the buyer has the skills, the requisite skills to operate the company, and that both buyer and seller have the same knowledge of the relevant facts involved, that one party isn't advantaged versus the other party. So an example might be the seller knows that there's about to be a plan that involves natural gas coming into his market. The buyer doesn't know about that, and it hasn't been disclosed. That would be a kind of an example. All right, another technical concept, valuation approaches and methods. Okay, we need to be thinking, what approaches and methods do we want to take? And there are really just 3 major approaches that valuation analysts take. We call it the income approach, the market approach, and the asset-based approach. I'm not going to dive too deep into each of them, but basically the income approach discounts cash flows. The market approach basically is based on observed transactions or publicly traded companies, and then the asset-based approach is where you treat the company as a collection of assets. Hard to do asset-based approach because we're solving one of those assets is intangible and goodwill, and you don't know that. It's not something you can observe. So realistically, we focus when we're covering companies in this industry, discounted future economic income and guideline transactions method. Discounted future economic income, that's where we view the business as a series of future cash flows, and it's going to be discounted back at some sort of rate of return. And that present value number is the value of the subject company that you're valuing. Key drawbacks to that is very difficult to forecast the future. We're not sure which or whose rate of return we should use in that. If we have a whole bunch of potential buyers, they all have different required rates of return. So it really needs to be the market's rate of return, and that's not something you can readily observe. And then the valuation model is subject to extreme variation because little changes in the underlying assumptions can cause big changes in the value that you conclude. So theoretically it's correct, but we only use it when the next method is not really available, and that's the guideline transaction method. Okay, so if in the perfect world you would know how every transaction, how every propane company that is sold, you would have information on kind of knowing the price at which it was sold, and you would know the underlying financial information. That's not really out there. It's not public. The people will have cocktail party talk and mention multiples and what they think things should go for, but that's not really observable information that's not quantitative. So basically, we want to observe recent sales of similar businesses. And when I say similar, other propane companies and somewhat reasonably close in size. And when I say recent, really needs to be 18 to 24 months. And the metric we zero in on to do this method is purchase price to the adjusted EBITDA. There are other metrics like sales to purchase price to sales and a couple of others, but this is really, we like to use this because across a number of observations, it's ignores the impact of financial structure in consideration. So you could have two different companies, one may be highly levered, the other not, but price to adjusted EBITDA ignores that fact and creates a level playing field. It's not perfect, but it's the closest to perfect we can get. Okay, so I mentioned EBITDA and I mentioned adjusted EBITDA. So you need to know this going in. Stands for earnings before interest, taxes, and depreciation and amortization. It's a fancy way of illustrating the operating income of a business before taking into account any of its capital expenditures or changes in working capital that are required to maintain the present level of activity. It does, as I mentioned, it permits comparison of companies and businesses regardless of the type and amount of the debt financing that is used in the business. And then we move one step closer. We say, okay, that's great, but you know what? These small businesses and even large businesses have certain items that are in your profit and loss statement that we use to build out the EBITDA that aren't valid or shouldn't be considered. There are three buckets I show here. We find things that are either misclassified or absent or even insufficient. And examples might be capital expenditures that shouldn't be on there, vehicle lease payments shouldn't be on there. Maybe bad debt expense has not been taken because the company hasn't needed to take it. So, and they just keep tax books, they don't keep two sets of books. So we may have to nudge bad debt expense up to a kind of a more realistic number. Rental expense, that might be something we need to adjust. Maybe it's not market. Maybe there is none when there should be some. So the second group are non-recurring, one-time things that don't happen every year or every 5 years. And then there are also things that are just not related to operational income or expenses. An example might be there might be some sort of life insurance, key man life insurance policy that has a separate account and there's investment income in it. And that investment income has nothing to do with the earnings capacity of the company. So we would back that out. And maybe there was a litigation action that was a once in a blue moon thing that really doesn't tell the story about the economic income. So we will eliminate that. And then probably the biggest number, and maybe I should put this at the top of the slide, would be the expenses that would likely not be incurred by a new owner. The most common one is owner compensation and perks. Small business people run a lot of personal expenses through businesses, but you need to add them back or you're going to ding your EBITDA. And so a lot of times we spend a lot of time working with the owners to identify that information so we can add it back. All right. So what we did here is we identified what EBITDA was in general, how we adjust it, and now the other part of that valuation equation was applying some sort of multiple. And so how do we get, what is the multiple that we've calculated? So we've taken a bunch of companies we've been involved in the sale of. We know what their EBITDAs are. We know what the transaction prices were at. And we will go ahead and we know what we can imply what the multiple was on those transactions. What does a multiple really mean though? And this is just an academic explanation of what's going on with the multiple, and it's gonna be a head scratcher for most folks, but I sat and thought about this for a while, and really EBITDA multiple just reflects the rate at which you think the net cash flows after taxes for business are going to generate. So even if it's an LLC or a S corp where the taxes don't hit the P&L, it's hitting it, you know, for a potential buyer it will, and so you have to value on an after-tax basis if possible. And so we don't do that with the EBITDA number. We do it, you know, or buyers do it through the multiple. And then how much of that cash flow has to get reinvested, you know, into the business? Fixed assets need to be replaced. Growth assets, you know, you need to buy more tanks, you need to buy more trucks because your business is expanding. So that's cash flow that won't be available for distribution to the owners. And working capital has to also keep pace with any growth. And then the last thing that folks kind of implicitly take into account, even if they're not thinking about it, is what their cost of capital is to the potential buyer. So these three kind of get mushed together and generate this multiple, and changing any of these three variables and the multiple changes. And as I mentioned, this was kind of the dry academic approach to understanding the multiple. Now let's get real. You know, here's reality. All right. People or companies that are who play the acquisition game, who are out there, they have a general sense of where multiples will be for different size businesses. They have general notions. They can't tell you exactly, but they're going to use their general notion, and then they're going to factor in how large the business is. Is this a negotiated transaction, one-on-one, or do I have to compete against 3 other buyers? The buyer may have a motivation for pursuing the deal that's non-financial, that may not be obvious. The buyer's ability to use leverage to get the transaction done goes to its cost of capital. If they're levered out, they might not be able to get the deal done. And also the perception of stability and growth of the cash flow of the business that they're buying. You know, if it's considered, you know, more unstable or less predictable, you would give it a lower multiple. They're also going to take into account if there's any synergistic cost savings and whether they can cross-sell services from their existing operation. So there are other things that kind of spill into why they might increase the multiple over a competitor who doesn't have those synergistic cost savings or the ability to cross-sell services. And companies will actually take into account the quality of financial data and operational records. This sort of is linked to the perceived stability and growth of the cash flow, right? Because if you're a little uncertain about what it is you're buying, that cash flow stream, you're going to ding your multiple to take into account that kind of added risk. So that's a shout out that you really want to keep all that information kind of going. Age and condition of physical assets, it doesn't drive the multiple, but it could nudge the multiple up or down because it's a matter of whether they take this into account in their EBITDA or in the multiple. But if it's an old fleet, you know, it's going to have pretty high maintenance and repair expenses each year. If it's a new fleet, those expenses really will just be maintenance. And if it's also an old fleet, they may be looking at a series of capital acquisitions or capital assets that they have to purchase in the not too distant future. So they'll ding their multiple for that. All right, so a lot of technical stuff. Sorry about that. We just needed to do that so you can follow along. All right, so you get back to Tommy with a proposal, and we call it an engagement letter that reflects everything we understood about our conversations with Tommy and what we think the assignment is going to be. And with that, we also give him a list of items that we need to get and a questionnaire to answer specific questions about the company. We're really trying to understand everything about this company before we put pencil to paper or start spreadsheeting. Tommy is very happy and signs their engagement letter. He says, these are, this is amazing. When can you get me the report? Which is the usually the next question. And he gets to most of the requested information. Now, in reality, folks give us a round of information. They give us 75%, and then we kind of pester them for the next couple of weeks for the rest of it. Once we've gotten all the information, we start reviewing it, and we follow up with an interview because we're going to have questions that arose, and we want to get an answer, answers to that. We want to understand the growth potential of the business and kind of the dynamics of how the business is run. Once we've had that conversation, we roll up our sleeves, or you're going to roll up your sleeves, and you get to work. Usually it involves a cup of coffee or two. So your goal here is to ultimately, you need to deliver Tommy a valuation report. And these reports could be fairly short of 20 pages, but most of the time they're going to be 40 to 60 pages in length because they contain a lot of ancillary information that kind of sets up the frame, the context for the valuation. It's really going to give some background about who's valuing who's doing the valuation work, give them a description of the target business, subject business, an overview of the industry and the economy at the time the valuation takes place. The valuation date may not be the current date. It may be as of the most recent fiscal year end. It could be some other date designated by the person that engages us. And we're going to do some historical financial analysis, and then we're going to discuss which approaches we considered, which we rejected, in methods too. And then we're going to kind of knit it all together and in the form of this valuation report. When we come up with the value, when we derive our valuation report for Tommy, we're going to deliver a draft report, and it opens a dialogue on, gives the owner a chance to challenge some of the assumptions or point out things where maybe we were deficient or hadn't thought about. So but in the end, we try to maintain our independence. So we start off with financial statements and we zero in on the profit and loss statement. So what you are looking at right now is a spreadsheet where we have taken the information given to us by Tommy. And so Tommy, gallons, we have propane gallons, and Tommy's business has kind of been a little flat between 18 and 20. And we go through and we look at his sales, historical sales, and we come down and we derive his cost of sales. So basically, this is all spreadsheet plugging based on financials he provided. We also put in all the various operating expenses, as you'll see. And now I'm going to change back. So then we have the various operating expenses. We lay all these out, and as you can see, it's not. It's pretty reflective of what kind of a middle of the road propane company might look like. Obviously, there are regional variances, so please take this with a grain of salt. But we lay all these out, and we have the sales and we have the cost of sales, and it generates the gross profit. So yes, sales have been going down, but we know that's just a function of propane pricing. But gross profit has in fact been climbed in 2019, and it says fiscal 2020 here, and the reason why is we're going to assume that we've already made it to year end 2020. All right, and so at the bottom, we end up with, once we subtract the operating expenses from the gross profit, we come up with an EBITDA number. And so he's doing pretty well for himself. You know, he's generated EBITDA of 1.2 million for the last 2 years. However, that's just EBITDA. That's not adjusted EBITDA. We have to look under the hood a bit. All right. We also we want to be mindful. We want to be mindful of the balance sheet. We get a current one from him because we're going to use these for adjustments later. And as you can see, he doesn't carry too much debt on the books. He does have a fair amount of customer deposits, $235,000, and about $134,000 of debt. Not a lot for a company of this size. So we move on. We say, okay, let's start thinking about adjustments. So we run the gamut. There's some really common adjustments in here. So we have, the owner's wages are down here, his vehicle expense, the fuel he uses for his vehicle, actually that may be for home, and then his payroll taxes. So we get to add all those back. Now, when you add those back, though, depending on how involved the owner is, the buyer may need to put in like a branch manager. So we have to take that into account. So we may not add back all of the owner's wages. It really is kind of facts and circumstances. But we feel like the business can run pretty well. So if you go back up here, you'll see that we're taking out all of the owner's wages. However, if we thought that we needed a $125,000 manager to replace him, then we would have to, we wouldn't eliminate as many of these owner wages in the payroll taxes. So just pointing that out. In 2019, Tommy put a new roof on the office building. And so that's a one-time item, but it was expensed. And so we're adding it back. It just because it's something that should have been capitalized. And for the same reason, under vehicle expense, it turns out that there's a bunch of truck lease payments that are in there, which are those are debt payments in nature. There's things that wouldn't really hit your profit and loss statement, certainly at EBITDA line. And then you've got an engine bill that took place in 19. So, we've had to ferret through a lot of information to look at that. How we know where to look a lot of times is when we'll look at metrics. So if we know that vehicle expense looked like it jumped in a particular year on a cents per gallon delivered, it poses the question in our minds, and then we can go ask the owner. In this case, we've also, there was no rent because Buy More Propane owns its property. So, and we're actually in this scenario going to value the company without the real estate. We're going to assume that Buy More goes out and get its own real estate appraisal because we're not realtors. We're not real estate appraisers. They're going to be able to give a much better picture on the value of that real estate. However, if you're going to value the real estate separately, you need to put in a market rent and reduce EBITDA for market rent. And then you're going to add the value of the real estate to the value that we obtain at the end of this. Okay, moving on. So now we've got adjustments in fiscal year 2020 of 650,000, which is quite a lot, right? So all of a sudden, our adjusted EBITDA, once we add those, now we're looking at adjusted EBITDA of $1.9 million. So that was a substantial increase through the adjustments. So now we have an adjusted EBITDA, and we, being Cetane Associates, we look in our kind of database of transactions, and we're like, well, a company like this is gonna fall into somewhat maybe 7 to 7.25 times EBITDA. And I present here, I look at actually that it says FY 2019, it should say FY 2020, and then a 3-year average. And we'll do that to just kind of look at the range and see how the numbers bump around. So what this number represents is the asset value of the business, not the equity value, but the value that the collection of assets, except for the real estate and except for working capital adjustments, what we will in cash, what somebody would likely pay for this collection of assets. All right. So we want to find out what the equity value of this company is. So I go through this exercise here. I show you again fiscal year 2020 and the 3-year average and a couple of different multiples, but things that need to be added or subtracted in order to arrive at what's the equity value. And primarily you're adding some working capital items, cash, inventory, receivables, and then you're subtracting whatever might be like an obligation that needs to be paid off at closing. Your short-term debt, your long-term debt, customer deposits. I mean, that's an obligation. There's going to be an adjustment, a closing adjustment. If you've got an HVAC business, there might be the service contracts you might have an adjustment for that, depending on how sizable. So we get down to this 100% equity value, excluding the real estate, and now we're thinking if we're focused on the 2020 number, you're looking at a roughly $13 million 100% equity value for this business. Okay. All right. So we're not being paid to come up with 100% equity value, though. But we need that to get to where we're going, which is trying to ascertain what a 25% equity value might be. So I'm going to introduce 3 more concepts here, and basically, when you're not buying 100% of a company, you're going to have to take into account other factors. So control, does that equity interest have control? Can you influence the strategic direction of making a company, of how it's run day to day? Somebody that has more than 51% control can even decide whether to distribute cash flow or not back to the shareholders. So it's pretty powerful, it's pretty valuable. And so if you don't have control, you would discount whatever it is you're buying. Marketability, or what we call saleability, is a company that's 100% interest is much easier to sell than just a partial interest. There's not a big market for partial interest. If you called up Cetane Associates and said, hey, can you guys sell the 25% interest in our propane company? If you're a small company, that would be difficult. If you're a large company, we might be able to find a private equity firm that might have an interest in doing a non-control investment. So the discount for a larger business is going to be a lot less, but there will still be an adjustment to the value. And I do mention liquidity here. Liquidity really refers to the time and energy and money that it takes to sell a business. Selling a business isn't an immediate proposition. If you can go into your E-Trade account, and if you don't like how Facebook or Google is trading today, you hit a couple buttons and boom, you've sold it off. You can't do that with a business. It takes a while. You need to prepare for the sale, and you need to market it, and then it takes a long time to get through closing. Generally, it might take 4 to 9 months, and there is a time value of money involved in that. You also have transaction costs. You're paying attorneys, accountants, Cetane. So it's not big. It's the control and marketability discounts or premiums are much larger. All right. So now we're getting down to the bottom line here. So now we want. So how do we get to a 25% equity value? And just a reminder, we're still excluding the real estate. Well, we take what we got for the 100% equity value, so we're roughly $13 million, and we take 25% of that straight off. So now you're looking at that 25% interest before adjustments is now like $3.3 million. So that's kind of your starting point. But now we have to apply these discounts we were talking about. 25% equity ownership in a a fairly, we'll say a down market business in the middle of California, it doesn't have the same value as a 50 or $100 million company. So discounts for lack of control in this instance, which you're going to have none, they can range from 30 to 50%. There are a whole bunch of studies, academic studies, that have been done over time. There's no hard and fast number. That's why I'm giving you ranges. It's very subjective, but in this case, for lack of control, it's going to get hit pretty heavily because it's 25% versus 50%. Unless there's something in the operating agreement that is unusual and gives more control to the minority holder. It's very, very rare. And so we're going to have to take off, $1 million to 1.6 million off of that 3.2 just on that. Then from there, we further have to add a discount for lack of marketability. These discounts aren't, you multiply the discounts, they're not, you do not add them. They each get applied to the layer before it. So the discount of lack of marketability can range 15 to 30%. So now we have to take off another $300,000 to $500,000. And so after these adjustments, we get down to a company that to 25% interest has a bit of a wide band. It's 1.2 to $2 million. It's probably on the lower end of that range if I had to guess intuitively. And if you look at the 3-year average, it's slightly less at the 1.7. So I think this is going to be somewhere probably between 1.2 and 1.5 million dollar equity interest. All right. So here I say that we can conclude that 25% in equity interest in Buy More is somewhere in the range of 1.1 to 1.9 million, and it's probably on the low end of that range. This gives Tommy the tool now where he can sit down with this other party or take whatever offer he's been given and properly evaluate it. And if the offer was for $2.5 million, it'll be like, great, that's probably over fair market value. I'll take the money and run. However, if the offer is for $900,000, he's like, no, that's not really going to do anything for me. So now we've reached that. What you're going to do is you're going to put all that into a report and deliver it to Tommy. And once you've incorporated any revisions he might have or any challenges you might have discussed, voila. So that is, in a nutshell, how you kind of value a partial interest in a company. So you learned how to, we basically learned how to value the full interest in a company and then took it one step further. Obviously, there's a lot more to this than what you can do in a 45-minute presentation. However, I think it gives you a pretty good understanding. And so with that said, I am going to take a look and see if we have some questions. I'm going to ask Nancy Coop to feed me some of these questions verbally because I'm having trouble actually being able to read them.
Sure.
Okay. Great. Thank you, Nancy. Nancy is our Director of Marketing here at Cetane Associates, and she keeps us all on our toes.
Josh, thank you. I've learned more about this than I thought I would, so I appreciate it. One of the questions that I had, because as you know, I've always been involved with bobtails, and but when I got into evaluations, to doing valuations for people, they always wanted to know what was the value of the assets, like the vehicles and the tanks, and how do you take that into account?
Yeah, that's a good question. Everybody's like, okay, yeah, especially we've seen this in transactions where folks are like, okay, but how much are you going to pay me for my trucks? So the value that we derive today, that 100%, the value of the assets, all right, that takes into account the assets employed, all the assets that are employed in the business, except in this case, the real estate. that will, and so it's already embedded in there. Basically, that asset number is comprised of tangible assets and intangible. And tangible assets can be physical assets, they could be financial assets like cash, or it could be your bobtail, or it could be your tanks in the field. So we're not valuing those separately, but what we are called upon to do is, once we know what that asset number is, we could value each of those buckets separately and back into what we think the goodwill or the intangible value of the company is. And that's actually often required at the end of a transaction. You need to allocate the value of the transaction to various asset classes for tax purposes. So there's certainly a need to know what the value of the trucks are and the value of the propane tanks, the value of the inventory. But ultimately, they are in the actual asset value that we calculate to start off with.
I've got another one here, which is always asked right up front. How long does evaluation take?
Well, it depends what we're doing at the time. I mean, in general, analysts aren't waiting for the engagement to walk in the door, but what happens is there's a initial period of data collection that is really highly dependent on the client and whether they have their act together and being able to provide that information. And then once we've gotten everything we need, it's typically like a 4 to 6 week process. It really depends on how many other things are on the analyst's desk at that point. And that's the same for any valuation analyst. It depends what they're working on, time of year. Sometimes there's a crush for tax planning purposes, and you may get a bunch of stuff in. But 4 to 6 weeks from the time that all information is collected is reasonable.
Another one I hear and is asked here is that people may not be ready to actually make they're not ready to sell, but they're really curious about the value of their company. Do they need a full-blown report? How do you handle variations on the scale of the report?
Yeah, no, it's a good question. Ultimately, you can provide direction to a valuation firm or valuation consultant as to what you want done. If it doesn't involve third parties, if this isn't a report that's going to be disseminated, you can certainly I could do something, any analyst could do something where he just does the calculation work and calls you up and gives you a number on the phone. He can do a short form report where he strips out a lot of the background material that is typically needs to be in the report if it's going to be shared with third parties. And typical third parties might be your bank or your attorney. It may go into a file for gift taxing purposes, just in case the IRS comes a calling. Those have to be real formally done reports. But if you're just interested in kind of getting what I would call a broker's opinion of value, you can do that too. And frankly, that takes less time and it'll satisfy your curiosity.
Great, I've got a couple more. This one is, I think, great. What tips might you have for maximizing the value of a propane business?
Oh, yeah, that's a big question, and with lots of different answers. So I'm going to collect my thoughts. So I would say that first and foremost is make sure all your financial and operational information is in good order. If people can't get through the numbers, they're going to ding you. So if your numbers and if your financial reporting and your operational reporting isn't up to snuff, get it up to snuff. It's probably the lowest hanging fruit, because if you can communicate numbers accurately and quickly to a potential buyer down the road, they're going to be like, well, these people have their act together, and they're going to have a higher confidence level. If you remember, we talked about earnings stability and believability. The other thing, it may be easier if you don't run. I understand small business owners run their personal expenses through the business. To the extent you can avoid doing that, it makes it cleaner. So that's kind of on financial reporting side. If you're not doing it, route optimization, look into tank monitors, look into calling out, less profitable commercial accounts. If it doesn't make sense, why are you doing it? Ultimately, you want to get your cash flow up, not not your gallons. Nobody buys strictly on the basis of gallons. It's cash flow. And there are some other less obvious things. But if you knew what the value of your company is starting off, you could see where which levers you can push. If you're about the size company that we just did today, maybe a little larger, getting a management team, developing your people so that if you're perceived by a potential buyer not needing to be involved in the day-to-day operations of the business, that this business will run without you, then you're not going to, you're first off, they love having a team present, and so they're gonna pay up for that. And B, your cash flow is not going to get dinged as heavy because they're not going to be thinking, well, I need to put in a $130,000 manager into the location. So those are kind of some of the tips. There are other things, but I think it's probably beyond the scope of this presentation.
That was a big question. Here's the last one. It is a bulk plan considered part of real estate for valuation purposes?
No. If you can move it and sell it, it'll be valued as part of the business assets and not the real estate. If you had a distillates bulk plant, that's pretty much a fixed asset, and that is part of the property. So when you have somebody do a real estate appraisal, I wouldn't let them include the price of or the value of the propane tanks in your real estate appraisal. Those are separate and apart. They're part of the physical assets of the operating business, not I think they call them personal assets versus real assets. So that's my response. Anything else?
I don't see any more questions here. Thank you.
You're most welcome. All right, if nobody has further questions, I do appreciate everybody spending the time today. And you can certainly reach out to me if you have any follow-up questions, and would be more than happy to answer those questions for you. So thank you very much, everybody, and have a great day.